Welcome to my YouTube channel. My name is Michael Mwansa Liova. Under Audit and Assurance Services, I would like to look at the purpose and process of external audits. When you look at the definition of an auditor, an audit can be described as an independent examination of the financial statements whose purpose is to express an opinion on the truth and fairness of the financial statements. We look at an audit by first looking at what are the two types of auditors, or what type of the two types of audits. There is what we call an external audit, and we also have an internal audit. The one I've just talked about is the definition relating to external auditing. So what can we say about the definition of internal auditing? Internal auditing can be described as an internal appraisal of the operations and financial systems in order to make a professional judgment based on the efficiency, which relates to the efficiency, effectiveness, and as well as the economy of those particular operations and systems. So you can see that for an external audit, it is that which is done by people who are external to the organization. They do not belong to the organization. Whereas an internal audit, it is done by people who are internal to the organization. They are part of the management of the organization. There are other marked differences between external audit and internal audit, which you can state as follows. For instance, under external audit, we look at the external auditor normally will be somebody who is got a recognized professional qualification and also belongs to a recognized supervisory body. And for external auditors, normally it is a requirement for certain companies who have reached a certain threshold in terms of turnover and asset base to have an audit of that nature at least once in a year. Okay, so when you look at the internal auditor, this person need not be a professional qualification, because it's management actually who assigns the duties and responsibility. In short, the management is the one that actually come up with a job description or the terms and conditions of service for this particular person. Okay, we also see that internal audit, and unlike the external audit, is not compelled by law. So you need not have an internal audit carried out as imposed by law, which is the case for external audit. We also look at an internal audit as a function that is going to be carried out where the internal audit department, okay, need not be supervised by a regulatory body. Okay, so those are some of the things that you look at under internal audit and external audit. So we basically look at external audit as a statutory audit. Audit that is a legal requirement and is performed by people external to the organization. And then for internal audit, this is not a statutory requirement and is usually undertaken by employees of the company. It's usually undertaken by employees of the company because it's common knowledge now this time that some of these particular functions can be outsourced. So is the case for internal audit. Let's look at the purpose of external audit in diagrammatical form. Okay, so we see that the directors are appointed by shareholders, and therefore the directors behave or act like agents of the shareholders who are the owners of the company. One of the functions of the directors is to prepare the financial statements, okay, to prepare the financial statement and also manage the company, okay. Now the shareholders need to measure performance of the directors so that they can decide or determine to what extent they are taking care of their interests in the company which they own. Now they do that by reviewing the financial statements which are prepared by directors. The question is, how sure are they that the financial statements that are prepared by directors are prepared and show the truth and fair representation of what they have been doing? It's quite difficult since they are agents, and this poses what is known as the agents-principal relationship. In this particular case, the shareholders are the principal and the directors are agents. So what the shareholders do in order to circumvent this particular dilemma is to appoint an independent person. An independent person in this particular case is the auditor. And the auditor, they are able to give a view and express an opinion on those financial statements without bias. Therefore, when the financial statements are audited, they actually make the auditors add credibility to these financial statements so that the shareholders can place reliance on them in order to measure accurately the performance of the directors. So basically that's what the purpose of an internal or external audit is. As I've said, just to emphasize, the directors are required to account for the liabilities and assets placed under their control, and an audit is another audit requirement, and the financial statements are examined by the independent expert, the auditor in this case, who is required to give an opinion on the truth and fairness of these financial statements, basically to give credibility to these financial statements. So you find that in the audit report, when expressing an opinion, the auditor does not vouch for the exactness of the financial statements. Rather, he expresses an opinion which is based on whether the financial statements show a true and fairness of those financial statements. So we need to understand the concept of truth and fairness here, which is used by auditors to express an opinion. A truth can be said to be a factual expression of those financial statements. So when you talk about the truth, it need not be exact, but it just needs to be a factual expression of those financial statement figures. So what do we mean by that? I can give you an example or an illustration to show that is what is used in our day-to-day lives. When we're looking at an entity that is reporting on the financial statements, big companies especially will actually use abridged figures or some figures that are just showing the factual expression of what has taken place. In this regard, I make reference to, for instance, an organization that is maybe reporting on a figure of 1,280,360 kwacha for the Tungwe. So for the management at the lower level, they might require the exact figure as I've said. But top level managers, might just require to be given a factual representation of that figure. In this particular case, you might see a report showing that, for instance, if these were sales, they'll say the sales were amounting to 1.3 million kwacha. 1.3 million kwacha. So one cannot dispute that that 1.3 million kwacha is a factual expression of 1,280,360 kwacha for the Tungwe. When you look at the other term which is used in this particular fairness means that you are coming up with a relative term. If it's a relative term, it means that it's something that is compared to another expected or a standard, okay, or another standard or another benchmark. In this particular case, the auditors will actually look at these financial statements and see whether they are in compliance with the accounting standards and other regulatory framework. Because the accounting standards are crafted in such a way that once they are followed, in most cases, they actually remove the chance of having those financial statements to be misleading. So they are said to be a fair presentation of those particular activities that would have taken place over the reporting period. So they look at whether in the preparation of those financial statements, the client, the auditee, had followed the required accounting and other regulatory framework applicable as a best practice in this particular field. So that's why you find that the auditors use truth and fairness in their expression of an opinion about the financial statement. The auditor this role is therefore to report to the shareholders on the degree of reliance they should place on the financial statement presented by the directors. Okay. The definition of an audit as an independent examination and expression of opinion on the financial statement of an enterprise is critical in the expression of in the preparation of audit report. So that's what we can talk about in terms of the purpose of an external audit. Let's look at the purpose of an external audit as it affects small companies, small company audits. The purpose of an audit, as we can see, it is to give an assurance or reassure the shareholders about the financial statements that are prepared to be, whether they are true, they reflected truth and fairness. Those financial statements, whether they reflected truth and fairness. So they give us the assurance. In many small companies, you find that the people, the owners of the company, are also actively involved in the day-to-day management of the company. So that poses a particular situation. Okay. In response to this, the audit. In response to this, we have seen that there is a relaxation of regulations relating to audit of such companies. Okay, as at 30th March 2004, companies in UK with a turnover of less than £5.6 million are exempt from having an audit. Okay, why? Because we find that if the owners are the same people who are involved in day-to-day management of the business, then there is a kind of an enhanced checks and balances placed in place by the virtue that they are the owners, and they definitely want to actually carry out activity in their best interest. Since they are actively involved in the management, then you can see that the rules that apply to not closely related members to the company in most of the big companies are relaxed in terms of an audit when it comes to small companies. Okay, so that's what you can say. But doesn't mean that if the small companies are owner managed, then there is no need of an audit. They can also benefit from an audit in the sense that they are going to receive expert advice on various issues relating to that company, and they might learn a lot from those particular issues. Okay, so that's why they still have an external audit being called upon. Okay, so an exemption is not permitted if, again, the company is a public limited company and also is in the banking and insurance industry, or it is a trade union, or a company registered under Financial Services Act. So that's what you should know when it comes to small company audits. We also need to look at the audit process in outline. Since we are talking about audit for some time now, how is the process carried out? Okay, when you look at an audit, okay, they need to have a plan to carry out an audit. Okay, they need to now have a plan to carry out an audit. Why need a plan? Why do we need a plan for an audit? Okay, so you see, the auditor is held in such a high esteem by the client. Okay, so it's only fair that they give services commensurate to the status they have been given to the client. So in order to do that, there is a need to add the function of planning to achieve that particular level of standard required of them as auditors. So in planning, before they plan, they need to, or when they plan, they also include aspects like make sure that they understand the entity, including the documenting, confirming, and accounting system and internal controls. So understand the entity includes understanding the documentation process, and also they will need to carry out the confirmation of the accounting system and internal controls to ensure that they are adequate and they can place reliance on them. Okay, why is it important to do that? For internal audits, for instance, internal controls rather, we will find that an auditor requires to evaluate the internal controls to assess the risk of material statements occurring in the financial statements. So if the internal controls are assessed to be strong, then the auditor can avoid substantive audit procedures and just look at the test of controls to ensure that they are actually working properly throughout the accounting period. So that's what it does. And also it reduces on the audit fees on the part of the client, because most likely less time will be spent carrying out an audit. Unlike when it is a substantive audit procedure where the auditor has decided using professional judgment that the internal controls cannot be relied upon. Therefore, there is a high risk of material misstatements being experienced in that particular entity. So this particular assessment affects the selection of audit procedures to respond to risk of material misstatements. Okay, as I've said. So how does it happen? Okay, where the risk assessment includes expectation that controls operate effectively, then what normally happens is that you decide as an auditor, or you expect control risk to be low. You expect control risk to be low. Okay. What do we mean by control risk? Okay. So control risk is the risk that the internal controls put in place, okay, fail to detect that material error or misstatement has taken place. Okay. So we also look at the other aspects. Suppose the risk assessment does not increase expectation that controls operate effectively, then control risk is high. Okay, so this particular chance that the control is placed in place will fail to detect that material error and misstatement has taken place comes to be high in this particular case. So now what happens if that's the case? Where the control risk is high, okay, they report to management. They need to report to management and also carry out a full substantive test procedures. Okay, that's what the auditor is expected to do where control risk is high. Okay, so then the other thing is that if test of controls confirm the expectation, okay, that the controls are operating effectively, then in that particular case, as I've said, the auditor needs to scale down on substantive test procedures and carry out mostly the test of controls to confirm that these particular internal controls which are put in place are able to operate effectively, efficiently, and economically throughout the accounting period. Okay. Where these tests of controls again having had an expectation that the control risk is low and the test control fail, okay, this particular the internal control fail this particular test, then they are taken to be unsatisfactory, and therefore this is reported to management, and what follows is that the full substantive tests need to be carried out, okay, despite the initial assertion that the control risk is low. But the tests have shown otherwise, therefore a report is made to management, and the auditor reverts to full substantive audit test procedures. Okay, so that's what happens. And if the tests of controls are said to be satisfactory, as I've said, as the diagram represents, restricted substantive tests or scaled down substantive tests are carried out. Okay, so this will lead to overall review of the financial statements, and then finally a report is made to management. So basically that's what we start looking at in this type of activity. Okay, in this type of activity. So that's what we have to know about an outline of audit process. An outline of audit process. So thank you for watching this video. I wanted to share with you the purpose of an external audit. Please remember to subscribe to my channel and like my video. You will still see more videos on audit and assurance in the next time, during the next time. So thank you for watching my video.